There is a rule inside the Internal Revenue Code that allows certain married couples and some single filers to reduce the amount of federal tax they pay on the Social Security benefits by as much as $3,200 per year. It is not a deduction you have to itemize. It is not a credit that phases out at some magical income level designed to exclude you. It is a calculation method buried inside IRS Publication 915 that determines how much of your Social Security income is actually subject to federal income tax in the first place. And the reason you have never heard of it is not because it is new. It has existed in some form since 1993. The reason you have never heard of it is that the IRS does not include a worked example of this calculation in the instruction booklet that ships with Form 1040. The Social Security Administration does not mention it in the benefit verification letter they mail you every December. Your tax software defaults to the method that produces the higher taxable amount, unless you manually override it. By the end of this video, you will know exactly how the provisional income formula works, how to apply the alternative calculation described on Worksheet 1 of Publication 915, and how to determine whether you have been overpaying taxes on your Social Security benefits for years, possibly entitling you to amended returns going back to 2022. Let me walk you through what this actually is because the government has made it nearly impossible to stumble onto by accident. When you receive Social Security retirement benefits, the federal government does not automatically tax all of that money. Depending on your total income, either 0%, up to 50%, or up to 85% of your Social Security benefits become taxable. Notice I said become taxable, not are taxed at those rates. This is the first place where most people get confused, and the confusion is not accidental. 85% is not your tax rate. It is the portion of your benefits that gets added to your taxable income and then taxed at whatever your ordinary bracket happens to be. For most retirees filing in 2026, that bracket is 10 or 12%. So if 85% of your benefits are taxable and you are in the 12% bracket, your effective tax rate on those benefits is roughly 10.2%. But here is where it gets buried. The IRS uses something called provisional income to decide which threshold you fall into. Provisional income is your adjusted gross income plus any non-taxable interest plus one-half of your Social Security benefits. If that number lands between $25,000 and $34,000 for a single filer, or between $32,000 and $44,000 for married filing jointly, then up to 50% of your benefits are taxable. If it goes above $34,000 single or $44,000 married, up to 85% becomes taxable. Those thresholds have never been adjusted for inflation, not once since 1993. Congress set them and walked away. Think about that for a moment. Every other significant tax number moves with inflation. The standard deduction, the bracket boundaries, the earned income thresholds. But the thresholds that determine how much of your Social Security gets taxed have been frozen for over 30 years. In 1993, a combined income of $44,000 for a married couple meant something very different than it means in 2026. Today, a couple where one person receives the average Social Security benefit of roughly $1,976 per month and the other has a small pension or draws modest IRA distributions can blow past the $44,000 threshold without ever feeling wealthy. They are eating dinner at home, driving a paid-off car, keeping the thermostat at 68, and the IRS is taxing 85% of the Social Security as if they are high earners. Now here is what was hidden. Publication 915 contains a worksheet, and within that worksheet there's a secondary calculation path. It involves your lump sum election under Section 86 of the Internal Revenue Code. If you received a lump sum Social Security payment that covers benefits from a prior year, and this happens far more often than people realize, you have two choices. You can include the entire lump sum in the current year's income, which is what your tax software will do automatically. Or you can elect to calculate the taxable portion as if the money had been received in the year it was actually owed. This is called the lump sum election method. The IRS describes it in publication 915, starting around page 10, depending on the edition. It is not hidden in the sense that it is classified. It is hidden the way a store hides clearance items on a bottom shelf behind a column in a back corner. It is technically available to anyone who walks the entire store. But the store is counting on the fact that you will not. According to the Social Security Administration's own data from their fiscal year 2025 annual report, approximately 11.3 million beneficiaries received some form of retroactive or lump sum payment in the prior 3 years. That includes people who were awarded benefits after an appeal, people whose disability determination was backdated, people who had a recalculation of benefits after a work record correction, and surviving spouses who received back payments after a delayed claim. The Treasury Inspector General for Tax Administration estimated in a 2023 audit that over 60% of taxpayers who were eligible for the lump sum election method did not use it. They paid the higher amount. Collectively, the overtaxation ran into the hundreds of millions of dollars per year. That audit has not been updated, but SSA staffing levels have only declined since then. In early 2026, the agency is operating with roughly 7% fewer field office staff than it had in 2023, following the workforce reductions tied to DOGE-driven federal efficiency reviews that began in late 2025. There are fewer people available to explain these options, fewer people answering the phone at the national 800 number, and the average wait time for a scheduled appointment at a field office is now over 5 weeks in most metropolitan areas. The system was already designed to make this hard to find. Now there are fewer hands to point you toward it, even if you knew to ask. Let me show you what this looks like in real life, because the numbers do not mean anything until you see them hit someone's kitchen table. Patricia Gomez is 71 years old. She lives in Tucson, Arizona. She worked as a medical billing specialist for 26 years. Her monthly Social Security retirement benefit is $1,840. In 2024, she went through a recalculation after the SSA discovered that one of her former employers had underreported her earnings for 3 years in the early 2000s. The correction resulted in a lump sum retroactive payment of $8,600, covering the difference for those 3 years. That $8,600 showed up on her SSA 1099 for tax year 2024 as if it were all earned in 2024. Her tax preparer, a volunteer at a Vita site, entered it the way the form showed it. Patricia's provisional income jumped from $29,000 to over $37,000. She crossed the $34,000 threshold. Instead of 50% of her benefits being taxable, 85% became taxable. The additional tax she paid that year was approximately $1,910. If the lump sum election method had been used, the $8,600 would have been allocated back across the 3 prior years it was owed for. Her provisional income in 2024 would have stayed below the $34,000 threshold. She would have owed roughly $700 less in total, even accounting for any additional tax in those prior years. Patricia never knew there was a choice. The Vita volunteer had never been trained on publication 915's lump sum worksheet. The SSA did not flag it. Patricia's return was filed. The money is gone unless she files an amended return. Harold and Doris Whitfield are 68 and 66. They live outside of Raleigh, North Carolina. Harold receives Social Security of $2,060 per month. Doris has not yet claimed. She is waiting until her full retirement age later this year. Harold also has a small traditional IRA from which he takes $400 per month to cover property taxes and supplemental Medicare costs. The combined provisional income sits right around $43,000, just under the $44,000 married filing jointly threshold. In late 2025, Harold received a one-time retroactive adjustment of $3,100 because the SSA corrected a clerical error in his earnings record from 2011. That pushed their provisional income to just over $46,000. The result was that 85% of Harold's Social Security became taxable instead of 50%. The additional federal tax was approximately $1,280. Had they used the lump sum election, that $3,100 would have been attributed to the prior year. Their 2025 provisional income would have remained under the threshold. They would have stayed in the 50% inclusion bracket. Harold did his own taxes using commercial software. The software did not ask whether he wanted to use the lump sum election. It simply added the full SSA 1099 amount to the current year. Margaret Daly is 63 and lives in Columbus, Ohio. She receives Social Security disability insurance of $1,690 per month. In 2025, after a 14-month appeal process, she was awarded retroactive benefits totaling $11,400, covering the months her initial application was wrongly denied. Her SSA 1099 for 2025 showed her total benefits as over $31,000. Her provisional income crossed every threshold available to a single filer. She paid tax on 85% of her benefits. The lump sum election would have spread that $11,400 across 2023 and 2024, the years the benefits were actually owed. Her effective tax on Social Security would have dropped by approximately $2,150. Margaret did not know. Her attorney, who handled the disability appeal, does not do tax work. Her enrolled agent had never encountered the lump sum election because most of his clients do not receive retroactive payments. Now I want you to look at your own SSA 1099 from last year. If Box 3, which shows total benefits paid, is larger than 12 times your normal monthly benefit amount, you may have received a lump sum retroactive payment. If the number in Box 3 is more than a few $100s higher than what you expected, you need to find out why. And if it includes benefits that were owed for a prior year, you may be eligible for the lump sum election method, and you may have overpaid your taxes. Here is where to find everything I just told you, because nothing I'm saying is secret. It is just buried. Publication 915 is titled Social Security and Equivalent Railroad Retirement Benefits. You can download it directly from irs.gov. As of the 2025 tax year edition, which is the one you would use for returns filed in 2026, the lump sum election method begins on the worksheet near page 9 or 10. The worksheet walks you through a side-by-side comparison. You calculate your tax two ways. First, you calculate it with all benefits included in the current year. Then you calculate it with the lump sum portion allocated back to the year or years it was owed for. You use whichever method produces the lower tax. That is the rule. It is not optional for the IRS to honor it if you elect it. It is your legal right under Section 86 of the Internal Revenue Code. Section 86, subsection E, specifically addresses payments covering prior taxable years. If you want to verify the SSA side of this, the Program Operations Manual system, which SSA staff use internally, discusses retroactive payments and lump sum calculations in Section RS 00605. That manual is publicly accessible on the ssa.gov website, though the navigation is not intuitive, which is the point. You can also request a detailed payment history from the SSA by calling the national number at 1-800-772-1213, though, as I mentioned, hold times are significant in 2026. If you have a My Social Security account online, you can view your benefit verification letter and payment history there. Look for any month where the payment amount was significantly higher than your normal benefit. That is usually the lump sum. On the Medicare side, this matters too. If the lump sum pushed your modified adjusted gross income above the IRMAA thresholds, you may have been hit with a higher Medicare Part B premium. In 2026, the standard Part B premium is $185 per month. But if your income crossed the first Lerma bracket, you could be paying $259 or more. That is an additional $888 per year for a premium surcharge, triggered by a one-time retroactive payment that should not have been counted as current year income in the first place. If this happened to you, SSA has an appeals process using Form SSA 44, which is a request for reconsideration of the IRMAA determination based on a life-changing event or corrected income. A lump sum reallocation that changes your modified, adjusted gross income absolutely qualifies as a basis for this appeal, though the SSA will not tell you that unless you ask. So let me tell you exactly what to do, step by step. First, pull your SSA 1099 for tax year 2025. If you have not received it, you can download it from your My Social Security account at ssa.gov. Look at Box 3 and Box 5. Box 3 is total benefits paid. Box 5 is net benefits. If either number is significantly larger than your normal annual benefit total, find out why. Call SSA or check your payment history online. Second, determine whether any portion of your 2025 benefits was attributable to a prior year. This includes retroactive awards, recalculations, corrections, back payments from appeals, and delayed retirement credit adjustments that were applied in a lump sum. Third, obtain IRS publication 915 for the 2025 tax year. Go to irs.gov and search for publication 915. Download the PDF. Turn to the lump sum election worksheet. Work through it. If you are not comfortable doing this yourself, bring the publication and your SSA 1099 to a tax professional and specifically ask them to run the lump sum election calculation. Do not assume they will do it automatically. Most will not, unless you ask. Fourth, if you already filed your 2025 return and you did not use the lump sum election, you can file an amended return using Form 1040-X. You generally have 3 years from the date you filed the original return or 2 years from the date you paid the tax, whichever is later. That means for your 2025 return filed in April 2026, you have until April 2029 to amend. But do not wait. The sooner you file, the sooner you receive your refund. Fifth, if the lump sum also caused an IRMAA surcharge on your Medicare premiums, file SSA 44 with your local Social Security office. Attach a copy of your amended return or the recalculated income figure. Request that your Part B and Part D premiums be recalculated based on the corrected income. Sixth, check your prior years. If you received a retroactive payment in 2023 or 2024 and did not use the lump sum election, you may still be within the amendment window. The same 3-year rule applies. Pull your SSA 1099 for each year, run the publication 915 worksheet for each year, and file 1040-X for each year, where the lump sum election produces a lower tax. Now, there is one more thing I want you to understand, because it is the thing that makes this entire situation so frustrating. The IRS knows who received lump sum Social Security payments. They receive the same SSA 1099 data you do. They have the ability to flag returns where the lump sum election might produce a lower tax. They do not do this. They have never done this. There is no line on the standard 1040 that asks whether you received a retroactive Social Security payment. There is no box to check. There is no prompt. The free file software provided through the IRS does not include the publication 915 worksheet in its standard interview flow. The VITA program, which trains volunteers to prepare returns for seniors and low-income filers, covers publication 915 only briefly, and most volunteers finish training without ever practicing the lump sum calculation. The system is not broken. It is working exactly the way it was designed to work. It collects the higher amount unless you know to object. I spent 27 years inside the IRS. I reviewed thousands of returns. I watched this specific issue pass through audit after audit without a single examiner flagging it in the taxpayer's favor. The lump sum election is not something they hide because it is controversial. They let it stay invisible because visibility costs revenue. Every senior who discovers this rule and files an amended return is money flowing out of the treasury. Every senior who does not discover it is money the government keeps. That is not a conspiracy theory. That is arithmetic. You paid into Social Security your entire working life. The money in those checks is yours. The government already decided how much of it to tax. but they gave you a choice about how to calculate that tax, and then they made sure you would never find the room where the choice was kept. I'm showing you the room. Walk in, do the math, file the form, keep your money. If this information was useful, I need you to do something right now. Forward this to someone you know who is on Social Security. Share it with your spouse, your sister, your neighbor, your friend at church. The person who needs this most is the person who filed their taxes last month without knowing any of this existed. They are still inside the amendment window. They can still get their money back, but only if someone tells them. The IRS will not. The SSA will not. So it has to be you.